Good morning, everyone. We're honored to be here today, representing the Maxis Group and our board of directors, headed by the Trota and the Fuentebella families. We'd like to thank the Philippine Stock Exchange and Bloomberg for inviting us over. Next slide, please. All right. MGI is the largest casual dining operator in the Philippines with 665 stores globally, 90% of which are in the country, while the rest are in select locations in North America, Asia Pacific, and the Middle East. Next slide, please. All right. Okay. Our company's roots can be traced as far back as 3 generations ago when our first Max's restaurant was built in 1945. So we started having franchise stores before the start of the new century. That was in 1998. Then integrated other brands in succession in the 2000s, ultimately completing our follow-on public offering in 2014. Now, to pursue our growth agenda in a dynamic and complex environment, we professionalized our ranks in 2017. So a number of us right now, Che Diaz and myself included, are proudly a product of that program. Soon after, synergies were realized both at the front of house with multi-brand flagship locations, and the back of house with a consolidated commissary for scale and efficiencies. Next slide, please. There you go. We have 10 brands in our portfolio, each one in a leadership position in the consumer spaces that they are in. Our core 4 brands are Maxis, Pancake House, Yellow Cab, and Krispy Kreme. We have been the master franchisees as well of Krispy Kreme since 2006, so it's been a while, and Jamba Juice since 2011. So very quickly, by way of background for our core 4 brands, we have been punching through generations with the Maxis brand as we serve Filipino favorites like our very much iconic, very much loved One Whole Fried Chicken. Family gatherings are best in Maxis restaurants. Now, Yellow Cab is our premium pizza and pasta brand that enjoys, frankly, cult-like following from fans who appreciate the quality that we put in our crust and the generosity of our toppings, like no other. Pancake House is our all-day comfort food brand. Young adults flock in our stores, have it delivered. Pancakes, waffles, tacos, chicken, spaghetti, burgers, basically all the things that make you feel good. Last, certainly not the least, would be Krispy Kreme. Is of course globally known for its incomparable original glazed, OG for short. So among the dozens of countries that market and sell this brand, Krispy Kreme, proud to say that the Philippines operating unit is in the top tier of operators in terms of building equity and building the business. So the other brands that you see on screen, Teriyaki Boy, Sizzling Steak, and Densios, are surgically assigned in the cloud, prepared in, cloud kitchens. So while not as ubiquitous as the core 4 brands that I just mentioned, they are nonetheless still present and are generating wealth beyond a brick and mortar through online and delivery. Next slide, please. So we have 10 directors in our board, led by our chairperson, Ms. Sharon Fuentebella, and our CEO, Mr. Robert Trota. The directors are third-generation owners who have a deep experience in the fields of restaurant, chain, and commissary management. So along with 2 independent directors, Mr. Periquet and Mr. Paterno, who are accomplished in their respective fields. Next slide, please. Our management team is a direct output of the professionalizing our ranks, as I mentioned earlier. So in simplest terms, our team is responsible for creating customer value and ultimately delivering it to the customers. So our CFO, who is with us today, Che Diaz, will be taking stage soon. So as you can see, we have also assigned COOs for our brand verticals. Supply chain is a separate vertical to drive scale across the brands. You can also see here that we have combined our analytics and new business group for a more integrated ecosystem. So this management team brings the critical thinking, discipline, and systems from other companies outside of Maxis Group, including food, FMCGs, retail, infrastructure, telco, and e-commerce. It is important to note that the management team works under the guidance of the board so that our pursuit of commercial goals is within the set purpose and vision of the company. Next slide, please. So as I mentioned earlier, we have 650 stores globally with 90% here in the country, the Philippines, and 10% in key parts of North America, Asia Pacific, and the Middle East. A little more than half of our network globally is franchised. Now, the global stage, North America, is primed for expansion for the Maxis brand, particularly as it is the brand that resonates most in Filipino communities. Locally, we are excited about the prospects, especially in the regions where the growth potential is attractive and where MGI, our company, is either underserved or unserved. What's good here is that we have new store models whose investments are, well, basically half of what they were before, making it made possible by the creatively thought of smaller footprint, which of course comes from the ability to see space differently from our restaurant systems team. So in return, this attracts younger, more mainstream franchisees to partner with us. Next slide, please. All right, so before I turn you over to our CFO, Che Diaz, this slide kind of brings it all together. So I have essentially covered numbers 1 and 5. Frankly, COVID has given us the gift of clarity on what we need to refocus on and what the possibilities are for our company. So our renewal is anchored on two engines that are running in parallel. And these are remastering the fundamentals, which is item number 2, and creating the future, which is item number 3. So our CFO will take you through a deeper discussion on number 2, which is remastering the fundamentals. Then I shall come back and close it with numbers 3 and 4 on creating the future and supply chain capabilities. So on that note, Che, you may proceed. Thank you.
Good morning, everybody. Thank you for taking interest at Maxis Group Inc. So over the course of the pandemic, what MGI did was really to turn the bend. We have wiped out our losses from 2020 and turning this around into a 535 million pre-tax income in 2021. Okay, so moving on to our first quarter results. We ended the quarter with 3.6 billion in terms of system-wide sales, which converts to 2.2 billion revenues. If you look at the numbers that we have posted for the first quarter of 2022, we have been hit by Omicron, but nonetheless, that did not stop us from actually hitting our targeted operating income and our net income before tax in these types of scenario. So if you take March alone as a single month, by us enjoying the benefits of level 1, our operating income for Q1 of 11% is actually at 18% if we consistently deliver what L1 is giving us. We have turned around how much we have in terms of our box economics by getting the most out of the revenues that we are getting, backed up by a very efficient fixed cost and a very healthy contribution margin. At the same time, if you look at our net income before tax in March 2022, as a single month, this is already 11%, which is surpassing our levels pre-pandemic. So over the course of the 2 years that we were hit by the pandemic, we actually took that opportunity to actually remaster our fundamentals, backed up by our stronger core, for us to be able to be ready now and ready for the future. Next slide, please. So if you look at the things that the market is giving us, we have been very resilient in terms of our cost monitoring and cost management. But we are happy to note that if you look at our system-wide sales and revenues, this has been constantly recovering from 2021. And if you look at the first quarter of 2022, we are actually almost at par with our fourth quarter 2021, which we all know is um, is a holiday quarter. Okay. Another thing that we have done is that we are also capitalizing on organic growth in terms of our same store sales growth quarter on quarter. So if you look at the our first quarter of 2020 when the pandemic first hit, this declined over that year and steadily climbed up in 2021, and now we're at 40% same store sales growth recovery. This is also a measure of how we are operating in terms of revenue and maximization of wealth. Aside from the stores in the network that we have across the brands that Ariel has mentioned a while ago, we have also expanded into adjacent industries, i.e., we are already in the B2B space. We are retailers, distributors, and we are also have cloud kitchens. And Ariel will take you through that later on. Another thing that we did is that in terms of our model, we have actually modeled it in such a way that dine-in will be an upside because we want our model to be pandemic proof, in which case we will survive regardless. We only have dine-in and we only have delivery and takeout as our channels. So if we look at our pre-pandemic levels, our profile is really 59% dine-in, which dips to only 7% on a lockdown scenario, climbing up to 26%, 38%, and now we're at 43% in 2022. Okay, so if you look at how much upside we have and that our models have been built as if there's no dine-in, and we know that dine-in is raking in also some margins for us, this is going to be very healthy in terms of our margins and in terms of our bottom line. During the pandemic, there are two brands that have been consistently strong. This is Yellow Cab and our Krispy Kreme, which we hold an international franchise for. And if you look at how Krispy Kreme is doing right now, we are already surpassing pre-pandemic levels. The highest upsides that we are seeing are really Max's and Pancake House. These were affected by the pandemic given the dine-in restrictions that the government has imposed, and we have been recovering quite healthily in 2022 for this. Another thing is that dine-in is known to be a channel which has high margins given the fact that we are not spending on aggregators and we have our store network in place. Okay, so again, aside from the steady stream of revenues and the recovery that we have built, we are also seeing some upsides in the dine-in, and we are also backed up by our box economics, signaling that our margins will be healthier as soon as the market keeps on opening up. Another thing that we are also counting on is not only how much the market is giving us in terms of top line, but we also did a lot of homework in terms of how we are operating the business. Okay, so as we remastered our fundamentals, we always have the insight of our bottom line has to be actually healthier versus where we are at pre-pandemic, in which case over 2020 and 2021, we have a healthy store network worldwide. We have 600 locally and 62 stores outside of the Philippines. Another thing that we did because we have scale is that we have synergized store and manufacturing capabilities. We also raked in supply chain efficiencies, which is also affecting us positively in our contribution margins. We have also maximized our digital ecosystem and marketing initiatives, given the fact that consumer has already shifted their spending online versus the brick and mortar space. Another thing that we did is we also optimized our operating and head office spend, in which case we have also itemized everything that we can actually save on and still be efficient at how we are doing things. With all the things that we have actually done over the past 2 years, we have kept our contribution margin at 50%. It's a healthy level despite the fact that if you look at how the restaurant space is, most of us are actually spending a lot on aggregators fees. But nonetheless, we have kept our contribution margin really healthy. Also a function of how much efficiencies we are getting in our cost of sales and a function of how we are doing in terms of supply chain and manufacturing. The other thing that we did is we kept our fixed cost low. We have cut our fixed cost by 40% over 2019. And what this means to us is that our break-even levels is already at 60 to 70% from where we are at pre-COVID. Okay. The other thing, aside from a lower break-even point, is that this is actually signaling that any upsides that we have in terms of revenue and system-wide sales will really go to our bottom line. Another thing that we have also put as a Bible is that we are also looking at how much we are recovering in terms of revenue versus how we are spending in terms of fixed cost. So as a rule of thumb, we actually cannot spend as much versus how we are recovering vis-a-vis how we are operating. And of course, we have very much well-loved brands that we are keeping. With all the efforts that we have in terms of our revenues and in terms of our streamlining of operations, we can also feel what this looks like in terms of our margins. So the first one is our gross profit. Pre-pandemic, we felt that this is already at a healthy 26.9%. And in the first quarter of 2021, this is almost at the same level. Okay. A year after that, the first quarter of 2022, we have reached the highest gross profit margin ever since the time that we have listed. I guess this is at 31.5%, which also signals how efficient we are in terms of cost management at the store level and even at our manufacturing facility. Another thing is that if you look at our core Ebitda margin, pre-COVID, this is at 15.8%. And right now, this is at 16.5%. Okay. Despite the fact that our revenues has not recovered similar to where we are at in 2019, our margins are actually healthier. And as long as the top line still recovers, then hopefully this trickles down to these margins that we are seeing right now. Earnings before interest and taxes is also almost there versus pre-COVID. And our net income margin looks to be at 2% only because we were hit by Omicron in the first 2 months of the year. Okay. Having said that, if you look at our prospects for the year and how March is doing and how much L1 is giving us, indicatively, these margins are actually healthier despite the headwinds that we are seeing, which we are also mitigating. Okay, so next slide, please. One of the things that we also did over the course of the pandemic is to check on our balance sheet strength. So despite the fact that it's already strong, we wanted to be resilient in any case of another virus variant or another virus, monkeypox and all. So one of the things that we did is we actually are efficient in terms of our leveraging. Our long-term loan profile is at 70% of where we are at 55%. And this pushes back some of our obligations back end. Okay, so we wanted ourselves to allow to recover faster in terms of operations, while our partner banks are still very supportive of us throughout the pandemic. Yeah, another thing is that we have kept our total loans intact, 4.5 billion, and our available credit facility is more than 10 billion right now. Okay, so next slide. So if you look at how we have transformed MGI as a business, we are actually resilient and pandemic-proof in such a way that we have built our box economics tightly and we have executed that in terms of our operations. Our bottom line recovery is actually faster than the top line at the level that we are even surpassing pre-pandemic levels. We are ready now. Our balance sheet is stronger and we have core brands under our belt. And we have been consistently delivering in terms of our operations, not only on the top line, but also on everything that is managed in terms of streamlined operations. And we are future-proof. Okay, so if you look at how our results are, our margins go beyond pre-pandemic levels. And our shrink to grow strategy actually enabled us to even go to adjacent industries, which is beyond the brick and mortar. Okay, so with that, I will turn you over back to Ariel again in terms of creating the future for MGI. Thank you, everybody.
Well, thank you, Che. All right, so beyond fundamentals, this section gives you a glimpse on how MGI is creating its own path and future-proofing our destination through a new source of wealth. So we refer to this as creating our future. Next slide, please. All right. Is really anchored in one-step adjacencies. So beyond being restaurant operators, we are also merchants, manufacturers, and distributors, not only for our own brands, but also to other companies, other brands who may be in need of such services. It makes sense to us because it ticks all the boxes that we felt were important to go into one-step adjacencies. To it, it is a proactive response to an evolving consumer behavior. It addresses a consumer pain point and a consumer need. There's a huge retail food market out there which is untapped, let alone by a developing a new category referred to as the restaurant quality food category. It maximizes current assets in our commissary and also in our technical expertise in food creation. And the fourth one being it's accretive to business. Next slide, please. All right. Well, it all starts with our world-class commissary, where we essentially stitch the whole chain in terms of demand forecasts, procurement, harmonization of ingredients, warehousing, manufacturing, distribution, co-loading, to give us scale and efficiencies. Next slide, please. All right. So honestly, our commitment to ourselves and our stakeholders is that we will be more than ready when the market is ready. So that only works not just for the front of house in terms of brand, product, retail models, but also the back of house, in this case, supply chain. So our new commissary has 3 times as much capacity as what we have today. And that tells us that we're really primed for growth. When the market continues to open, we will have the capacity to get as much growth as we can. In terms of capability, it is really the bedrock of innovation for meats and sauces, bakery lines, frozen food and shelves, and even shelf-stable formats. It is built for quality in line with global standards, World Health Organization, UN Food and Agricultural Organization, even USFDA. It meets the highest levels of safety standards, whether that be GMP, HACCP, or ISO 22000 in this case. And yes, our bake shop is actually certified for halal products. Next slide, please. All right, so we have complemented this back of house capability with front of house distribution. So we're talking about general trade distribution, hundreds of key account doors in supermarkets, groceries, convenience shops, and including e-commerce platforms. So next slide, please. So essentially, we have established our company MGI as a legitimate presence in the phygital store space with both online and brick and mortar presence, right? So, and we're doing this with no investment, no capex at all as far as building stores is concerned. So next slide, please. And I think this is the last slide. All right. So in closing, as Che mentioned, we have turned the bend. As we committed to ourselves and our stakeholders, we were more than ready when the market is ready. And in 2021, that level of preparation, which started in 2020, finally met opportunity, leading to a rebound that, of course, everyone is aware of at this point. So a rebound has our top line growing faster than industry, therefore indicating that we have at least protected our market share despite having to close some shops as necessary. There was a huge turnaround in terms of net income, as Che has shown earlier. You also see that there is a quarter-on-quarter growth momentum, so that quarter continues even for Q1 this year. Despite having Omicron in the first months of the year, right? So I think we're churning twice as much income as we have before. You're also seeing that margins continue to improve. Our total Q1 margin is already comparable to pre-COVID. And when you look at the lone month of March, which is our first time that we hit level 1, which is the closest thing that we have to pre-pandemic, the margins actually beat March 2019 already, which of course to us, on a going basis, should the conditions prevail, would be the norm. We're growing organically in terms of same-store sales growth, which indicates that we have a healthy core and we're really primed for expansion. And lastly, we did share with you our supply chain capabilities in both capacity and capability terms to support our core of core business and a new business too. So on that note, I think that ends our presentation for today. We thank you for listening. We're open for questions if there are, Tamara.
Yes. I was just waiting for a prompt. I guess we're not going to get a prompt. So, so we have a little bit of time to ask some questions to follow up. Can you just talk us through how you pivoted your business throughout the pandemic? I know the pandemics have had these waves. How did you respond to that?
Well, the real work started in 2020 when we, as we say, compressed 3 years of strategy into 3 quarters of execution. So when lockdown started in March 2020, one of the first things that we did was to reassess our 3-year runway, which we've always had even prior to COVID. It's a matter of discipline. So that exercise brought forth 2 engines of growth, both of which you've heard today. One for core of core business, which remains to be a restaurant business, and that's referred to as remastering the fundamentals. And another engine for one-step adjacencies above our core, and that would be for us functioning as manufacturers, distributors, and merchants, and we refer to that as creating the future. Now, beneath, say, remastering the fundamentals, then you are looking at new business models, particularly in box economics, as Che mentioned earlier. So essentially, we have 3 levers that we work on. Obviously, that's revenue, fixed cost, and contribution margins. So it's essential for us to have reconfigured that box economics, essentially significantly lowering the break-even to 65 to 70% of what it was before, for us not to bleed, even if the circumstances weren't as pleasant, say the least. So the way to doing that would be to make sure that there are positive spreads, say, between fixed cost and revenue. Like in no circumstance would the revenue be dipping significantly lower than the dip in fixed costs compared to 2019. So therefore, you have positive spreads right there. And then you couple that with consistently delivering the contribution margins month on month on month, making sure that you take care of your variable costs that way. So if you kind of handle the 2 out of the 3 variables, in which case, contribution margins and the positive spread between revenue and fixed costs, then you have more than a fighting chance to be out of the red and obviously be in the black and ultimately be in the green. So that's essentially the journey that we had in pivoting. So Che may want to add in terms of other details. Thank you.
Thank you, Ariel. So just to add, one of the things that we have also consistently done is that we have kept our contributions at a healthy level, despite the fact that we have spending some money in terms of aggregators and other things that are relevant for delivery and takeouts, which we all know are the channels that are active during the pandemic. So another good thing is that we have a mix of brands that actually serve all demographics. And some of our brands have actually already recovered as early as 2021. And example for Krispy Kreme, it has already surpassed where we are at versus 2019. So aside from the box economics that we have, it's also consistency in terms of execution, in which case we have seen the effects of this one in 2021 in terms of our margins. But we are also feeling the good effect of what level 1 is giving us starting March. So hopefully it continues throughout the year, and hopefully we're in a better position by the end of the year. Thank you, Tamara.
Yeah, very interesting. So you've made all these adjustments to the pandemic. So and you've got this new model. Now what? Now that we're looking at reopening and maybe a new normal, is this sustainable? Where do we go? Where are you going from there, or going from here?
Well, yes, in MGI, we've always moved with the intent to making things progressive and sustainable. So the short answer to your question, Tamara, is yes. The new model that we have is repeatable, as evidenced by our quarterly growth despite various lockdown restrictions still. No? As you may have seen our results in exit 2021 and even in quarter one 2022 with Omicron. So I'd like to think that we took care of our brands, core brands particularly. They're in a great position for further growth and realize the upsides of this more efficient model. The same store sales growth are at double digits. And yeah, it should get better as we prime up for expansion. Now that the marketplace has settled, that certainly is the next step. So, thank you.
Thank you. You mentioned your international business. That's about 10%. Do you have any plans to expand those in that area?
Well, yes, our international business has grown significantly. In fact, it has, as Che mentioned, surpassed 2019 levels already. It is around a fourth of our system-wide sales. Recovery was faster in those parts of the world because, there are more relaxed restrictions abroad. And, our continued expansion in North America particularly really helped. We just opened Guam the other month. I know we're in Houston. And we were in Hawaii, a year back. So I think those things really help, particularly for brand access. So we do recognize the huge potential for MGI to continue expanding, globally. So plans for store openings are in place, right? So we try to partner with the right operators, so that's what we have. Thank you.
Very good. Here's a question on the commissary. So that was built based on the pre-pandemic demand, if you will. How do you see that those operating efficiencies carrying forward from here, or you have some expansion plans?
Well, the core purpose of our commissary is to serve our stores and our this time external partners with quality, cost optimization, and responsiveness. That's pretty much been our code ever since, even prior to COVID. So part of our efficiency initiative is to, as I mentioned earlier, stitch the chain by consolidating and integrating our assets across all brands. So our newly built commissary plays a critical role in this initiative. We have leveraged our size and our volumes across all our brands to reduce production costs while keeping our service commitments at still high levels. So on top of these efficiencies in consolidating our supply chain, harmonizing ingredients, making sure that we run a very simple level of operations to keep the costs down, our commissary provides the group with capacity and capability, particularly in terms of innovation. To serve our guests, our customers, our core of core products in a restaurant business, and of course to serve as well our adjacent industries that we have entered, which of course I just described earlier. So worth mentioning as well is that our commissary plays a key role in shielding our restaurant and retail business from very sharp inflation hikes, which of course we're all experiencing. So through the years, it has significantly mitigated the effect of steep raw material price hikes, so that the store business, whether it be company stores or franchise stores, remain to be viable and sustainable.
Interesting.
Thank you.
Kind of on keeping on the supply theme, are you experiencing any particular headaches with the supply chain disruptions that we're hearing about in the press, and elsewhere? We've heard about labor shortages, and do you have any hiccups there?
Well, that definitely is a challenge. We're facing serious headwinds as far as raw material price hikes are concerned. You kind of have to include there as well fuel/oil, and of course the mandatory wage increases that we have in this part of the world. So yeah, that's been scoped and it has been translated to an operating plan, which of course we intend to mitigate based on the operating plan that we have. Just wanted to share with you very quickly our sets of principles as we do mitigate this through our operating plan. Number one would be there is no one part of the chain that can fully cover for all the headwinds. Not the commissary, not the stores, whether that be company or franchise, and certainly not the consumer, because there's going to be a huge imbalance in the value proposition that makes it not feasible. And therefore, what we've done was to really first take a look at the efficiencies that we have, as far as our commissary is concerned. And I just mentioned that we've integrated the pipes on that one, making sure that we harmonize our ingredients, we cut the tail, we leverage on scale, we simplify our model, so on and so forth, so that that alone will pretty much get a good chunk or mitigate that part of the risk. And then when we've exhausted much of the identified efficiencies, that's when we go, all right, then perhaps the transfer prices to our own stores will have to be increased, which of course we have to some degree. And you kind of push a little bit more, eventually the consumer. Now, when you push prices at the consumer level, the second principle that we put in would be it's more about category management than it is, say, as we refer to, product management in this case. So we look at it in terms of categories, and the principle would be, keep your floor low and your ceiling high, so that in which case you will still have products that are door busters and keep our transaction counts coming, because that really is the lifeblood of a restaurant business, while protecting your margins and protecting your basket size, because you've kept the ceiling high. And the way to doing that would be to having a tiered pricing strategy, which is a function of a tiered product assortment. That's what we do for the brands that we have. There are tiered product assortments. So just in case your appetite was this much, then you will have to pay for it. And of course, if you didn't have that appetite, then you could, of course, try the entry-level products. That's what we do. Thank you.
Thank you. I think we have time for about one more question before our lunch break. So, from my perspective, looking across ASEAN, I've seen, of course, during the pandemic, we've seen investment kind of fall off. How is the interest level for your franchise business held up over the pandemic, and what do you see in the near term as far as the trends for that side of the business?
Our brands continue to demonstrate strong equity in the market. Frankly, it was during the pandemic that we saw quite a higher level of interest of franchising. And it's interesting because we see that the market for franchising has gone younger. So I guess the market has seen and experienced themselves the pivot that we have made, especially in product offerings, say where we put do-it-yourself tacos as part of our pivot, and retail digital solutions. And that's why, even for our most iconic brand at this point, which is Max's, which is, 77 years serving the Filipino community, easily 2/3 of our consumer base right now would be Gen Zs and millennials, right? So there is much faith on our way forward. The consumers have seen that, and the younger entrepreneurs, businessmen, have seen that too. So it helps our new store. It helps that our new store models are designed with significantly less footprint because of what we're seeing as some trends in the market as well. Just we work in a hoarding model, really depends on the restrictions, and hence this would require less investment. When you have less investment, then perhaps obviously the returns would be faster. So what this does is that this further broadens and democratizes, if that's even the word that is right to use, the appeal of franchising for MGI. So, thank you.
Very interesting. Sorry, I had one follow-up on that. So, in this respect, do you see yourself growing your network across the Philippines and other areas?
Oh yes, for sure. In fact, we're starting this year. Now that we have proven that our same-store sales growth is like consistently and in fact accelerating to pre-pandemic levels, so we have faith that our core growth comes from organic reasons. So that's the first piece. And now that we have the new store models, second piece. The third piece is that now that the market has settled, the dust has settled into what it will be like, then for sure we're back to expansion this year. We're starting this year again, as we have prior to COVID, for both local and the international stage. As much as expansion to us is important in terms of brick and mortar, what we do, we always want to reframe our mentality into, from brick and mortar, we talk about points of access. It's not necessarily going to be a full store. It's also going to be points of access. So, say as an example, Krispy Kreme Global, we're working with Krispy Kreme Global in driving CPGs or consumer packaged goods in a format that's not necessarily a total brick and mortar. It's a delivered fresh daily format, and for sure you've seen it in some countries as well, Tamara. And that's something that we roll out massively as well in this side of the world. That's one. The second one, of course, be what we mentioned earlier to be cloud kitchens. They are giving us tremendous upside in terms of delivery average daily sales for the mother store. So that's where we put our cloud brands, as I mentioned earlier. So these are points of access beyond brick and mortar. Yeah, thank you.
Thank you. Terrific. So that wraps up our morning session for the first Investor Day. We still have 2.5 days of sessions with our featured list of companies, but for now we're going to take a lunch break. And after our afternoon session is going to start at 1:30 p.m.